Well, joining us now for a macroeconomic or market outlook for this year is Peter Brooke, Head of Macro Solutions at Old Mutual Investment Group. Peter, perhaps when you take a look at what's taking place on the markets globally, it doesn't seem as though there's a positive outlook. There's a weak rand, talks of continued tapering, as well as this emerging markets exit story. So from an equities or market perspective, is the outlook positive?
In terms of the equity market, the outlook has deteriorated. And the simple reason for that is because we had such a good year last year, the market re-rated. The price-earnings ratio got a lot higher, and therefore our expected returns fell. The interesting thing, though, in terms of asset classes at the moment, is this turmoil is causing fixed income to get cheaper. So both bonds and listed property, in terms of our expected real return. So just to clarify, we look at the world and we say, what do we expect is going to happen in the next 5 years? And we look at those valuations. So where we were very negative a year ago, we've actually been upping our expected returns from property and bonds. And in the last month, the further sell-off has actually started to increase those expected returns even more.
That's interesting. If you've got quantitative easing, which is creating money hand over fist, and creating huge amounts of debt, at some point in time that debt's going to have to be repaid or heavily reflated. So bonds?
I think there's a difference between global bonds and SA bonds. If you think back, we've always had a real return in terms of our inflation-linked bonds. Now, those have actually just increased dramatically in the last month. Inflation-linked bonds sold off by 4%. So if we do get inflation, those assets are still protected and will still give you a real return. So the point that I'm making is where we had negative real returns on global bonds, we've now pulled that up to probably nothing, which is still an unattractive investment. On South African bonds, we've now increased that from an expected real return of 1.5% to 2%, and the next move will be to increasing that to 2.5%.
No, good thinking. I think everybody can buy that argument, but global bonds, little bit scary. Peter, just to take what we brought back from the World Economic Forum, the Americans are more confident, they're growing more rapidly. Europe, also their problem 4, Greece, Spain, Portugal and Ireland are out of intensive care. Other parts of the world looking better. Japan, of course, Abenomics seems to be working. Developed markets do appear to be in a better shape at the moment. From your perspective, would there still be value in the equities?
Yes, is the short answer. We have cut our expected return from global equities because they've also re-rated. But in terms of expected real returns from here, I still think you'll get a decent real return. And on a relative basis, remember you're competing with negative to nothing on cash and bonds overseas. I think equities will still have the edge. In South Africa, it's a little bit more tricky because our market has re-rated quite materially, and unlike the rest of the world, where our macro is getting, where their macro is getting quite a lot better, we're starting to get rate hikes, providing a headwind.
But Peter, what about the overall risks involved?
Look, I think in terms of risks, the big risks are it's too hot. So in other words, America grows too fast, and that causes short rates in America to come up quicker than we expect, which would be bad for asset markets, particularly equity, I think. The other risk is too cold, which is Chinese growth slows down, and that's clearly the risk that's playing out at the moment with the latest industrial production or PMI numbers coming out of there. And in both cases, South Africa sits caught between the two. And that's really our problem, is we're the ham and the sandwich. So we get it from both sides. And the other final risk is emerging market contagion, which obviously affects us. So we've got a situation in South Africa where we're hiking rates because of what's happening on a global basis, not what's happening in terms of growth. In fact, growth in South Africa looks pretty soggy.
It's interesting you mentioned emerging market contagion, Peter. Looking at the Indian situation in isolation, which is an important emerging market, they're quite confident that after their election in May, the economic growth there will go from 5% to 8%. Chinese are confident that 7.5% is their minimum. Overall, surely they'll come back into favour.
I think in terms of the short term, you've got to look at the delta of change rather than the absolute growth. So the developed world is going from 2 to 3, it's a +1. Emerging world is basically flat, but at a higher level. In the long run, that better growth, as long as it flows through to better profits, which has not been the case, would favour emerging markets. But in the short term, the rebalancing that is being forced upon them in terms of weaker currency, higher interest rates, puts a severe headwind to domestic consumer or domestic consumption type growth and shares.
Obviously, the currency has a big impact when you're talking about investing not only in the South African market, but anywhere in the world. The rand, we don't have to tell you, has come under a lot of pressure. Are we at an oversold position?
I think probably 80% of this move was completely justified, and we're now moving into cheap. The difficulty is markets don't settle at fair value. If you look at the real value of the rand, it doesn't spend a lot of time around that average range. It tends to overshoot both on strength and in weakness. So it's incredibly difficult to call that. We are starting to see value. It's no longer a one-way bet that it is weaker rand, but essentially we're having rebalancing forced upon us. It was interesting, I saw an article, I think it was the union saying, oh, we shouldn't have hiked rates. But the truth is, because our labour has been priced out of the market, because we become uncompetitive through high real wage increases and we can no longer compete, that's why the currency was forced weaker. It's why the SARB had to hike rates. They were forced by global markets, and that basically stemmed from our uncompetitiveness.
So, Peter, for South African investors, how should they position themselves? Offshore versus local, perhaps?
So we would still prefer offshore equity to SA equity. That's predominantly on a risk-adjusted basis and in terms of the relative value on offer. I think in terms of the local market, as fixed income sells off, we should be looking for opportunities in long bonds and listed property. And that's really on a longer term valuation. It's starting to show a lot of opportunity, and you're just balancing that off against those risks that I mentioned.